Money is a fundamental part of our daily lives. We earn it, we spend it, and we save it often without thinking deeply about what money truly represents or how it works. With money's intangible nature in our digitized economy, there's a common tendency to fall for the money illusion, a cognitive bias whereby we confuse nominal value with real value, neglecting the nuanced reality of money's purchasing power. Money illusion can particularly apply to our perception of savings within the traditional banking system. For centuries, the conventional wisdom has been to store your wealth in a bank. It's seen as responsible and safe, a refuge for your hard-earned money where it rests quietly, seemingly growing over time. However, this traditional picture is being challenged. To understand why the banking system may be failing to safeguard and grow your wealth, it's important to realize the concept of fiat money. Unlike assets like gold and silver, which have intrinsic value, fiat money is backed solely by the trust in the government that issues it. This means that its value is not anchored in a physical commodity, but rather it's susceptible to fluctuations in trust and policy. Central to this understanding is the realization that money doesn't hold an unchanging value. The amount in your bank account might stay the same or slowly tick upwards due to interest, yet if money's purchasing power is decreasing, you're not truly growing richer. The banking system has been built to capitalize on this illusion. The interest rates offered on most savings accounts are meager, to say the least, and often they pale in comparison to the rate of inflation. To illustrate, let's posit a simple scenario. You stash a sum of money in your savings account, and the bank tells you that you'll earn an annual interest of 1%. Assuming there's no inflation, that sounds like a modest but guaranteed growth of your wealth. However, if inflation runs at 2% or higher, your purchasing power diminishes. After a year, you might have more money on paper, but what that money can buy in real terms has lessened. Banks benefit significantly from our deposits. With the fractional reserve banking system, they're able to lend out multiples of what is actually held in their vaults, earning interest on loans and investments, a margin far above what they pay depositors. This creates a system that benefits the banks more than the individual saver, whose funds essentially enable the bank's profitability through loans and credit. Moreover, the wealthy often avoid these pitfalls by opting out of the money illusion. They're likely to invest in assets like real estate, commodities, and businesses. These assets have intrinsic value or generate income independently of currency fluctuations. But what exactly can we learn from their example? First and foremost, the concept of saving money should not be solely about hoarding cash in banks. Understanding money as a tool rather than an end in itself is vital. Saving effectively in today's economy might look more like diversifying one's assets to protect against inflation and profit from the appreciation of investments that hold or increase in real value over time. Historical lessons have taught investors that wealth preservation often involves a departure from purely holding fiat currency in low-interest accounts. Real value comes from understanding money's nature, keeping ahead of inflation, and wisely choosing assets that aren't prone to the detrimental effects of increased money supply and government policies. In conclusion, while leaving your money in the bank might feel like the comfortable, traditional route, it's critical to recognize the pitfalls of money illusion. The safety we attribute to banks might be a mirage when we consider the erosive power of inflation and the relatively higher benefits that banks reap from our savings. Shattering the money illusion involves recognizing these realities and taking proactive steps to truly grow wealth. Inflation is often referred to as the silent thief because of its insidious ability to erode the value of money over time. When people save their money in traditional bank accounts, they may not be aware of the impact that inflation can have on their savings. Understanding this force is crucial for anyone looking to preserve and grow their wealth. Firstly, to truly grasp the erosive power of inflation, it's imperative to understand what inflation is. In the simplest terms, inflation represents the rate at which the general level of prices for goods and services is rising and, subsequently, the purchasing power of currency is falling. Over time, inflation reduces the quantity of goods or services you would be able to purchase with the same amount of money. Let's paint a more detailed picture of inflation and its implications on your savings. Imagine that you place $10,000 in a savings account with a 1% annual interest rate. After 1 year, you'd have $10,100, a modest gain. However, if the inflation rate during that year was 3%, the real value of your money would decrease, not increase. The things you could purchase with $10,000 before you saved it are now more expensive, and despite the increase in your balance, you're actually able to buy less with your $10,100. This gap between the nominal interest rate, the percentage increase to your account, and the inflation rate, the percentage decrease in purchasing power, can lead to a negative real interest rate, meaning your savings lose real value over time. It's a particularly concerning issue for long-term savers, as the compounding effect of inflation can have a significant impact on future spending power. The factors contributing to inflation can be multifold, and some of the key contributors include demand pull inflation, which occurs when demand for goods and services exceeds supply, and cost push inflation, which happens when prices rise due to increases in the cost of wages and raw materials. Another prominent factor is the increased supply of money, sometimes referred to as monetary inflation, where more currency in circulation dilutes the value of each dollar. Recognizing the types of inflation is only part of the battle. The challenge for savers and investors is in their approach to managing this risk. Traditional savings accounts are relatively low risk when it comes to the return of the capital, but they're high risk when it comes to the return on capital due to inflation. The security they offer is often illusory, as it doesn't account for the reduction in purchasing power. Combating the erosive nature of inflation demands proactive financial planning. While there's no one-size-fits-all solution, a diversified strategy can mitigate some of these effects. Diversification might include a mix of inflation-protected securities, like Treasury inflation-protected securities, TIPS, in the United States, or investing in assets that historically have hedged against inflation, such as real estate or certain commodities. Another important factor is the constant vigilance and adaptation of your savings strategies in response to varying inflation forecasts and rates. Recognizing times of economic change and adjusting your savings approach accordingly can help maintain your savings' real value. Moreover, understanding your personal inflation rate, which may differ from the widely reported Consumer Price Index, CPI, is key. Your lifestyle and expenditure patterns might mean that your inflation rate is higher or lower than the average, influencing how you should respond to inflationary pressure on your savings. In conclusion, to safeguard your wealth amidst rising prices, it is vital to recognize the limitations of traditional savings accounts in the face of inflation. By gaining a deeper understanding of how inflation works and adjusting your financial planning to counteract its effects, you can help ensure that your savings retain their true value over time. Remember, the goal is not just to grow your balance, but to grow your purchasing power, maintaining the ability to enjoy the lifestyle you save for. To achieve long-term wealth accumulation, it is not enough just to focus on saving and investing. It is equally important to revolutionize your spending habits. The society we live in has a strong emphasis on consumption, with constant encouragement to buy more and to equate spending with happiness. However, this consumption treadmill is rarely the path to true financial security or wealth accumulation. Changing our perspective on spending can have profound implications for our financial future. It begins with seeing money not just as a currency for transactions, but as a tool for creating a more secure and enriching life. By shifting our focus from immediate gratification to long-term wealth building, we can begin to make changes that compound over time. One of the first steps in this change of mindset is to establish an emergency fund. This is not just traditional wisdom, it's a robust buffer that can prevent unforeseen circumstances from derailing your financial plan. An emergency fund helps reduce the likelihood of incurring high-interest debt in times of urgent need, thus protecting your long-term financial goals. From there, it's prudent to take a hard look at your current spending habits. Are you making purchases out of habit, social expectations, or emotional responses? By actively questioning each expenditure, you become more aware of how you use your money and can start making more strategic decisions that enhance rather than undermine your wealth accumulation. For example, think about subscriptions you may automatically renew without considering their value to your life, or purchases you might make just because something is on sale rather than out of necessity or long-term value. By eliminating non-essential expenditures and prioritizing spending that aligns with your values and long-term objectives, you'll be able to redirect more of your resources towards saving and investing. Another area to examine is impulsive spending. Delaying gratification can be a powerful tool for wealth accumulation. Before making a purchase, especially a significant one, give yourself a set period to consider whether it's something you truly need and whether the expense is aligned with your long-term financial plans. What you want in the moment may not be what you value over time, and recognizing this can save considerable amounts of money. Revolutionizing your spending habits also means focusing on maximizing value. This doesn't necessarily mean always buying the cheapest option, but rather seeking the best cost-to-use ratio. This principle applies not only to material goods but also to services and experiences. Evaluating what brings lasting satisfaction versus what provides only a fleeting pleasure can drastically change your spending patterns. Adopting a minimalist approach doesn't mean living austerely, it's about discerning what you need for a fulfilled life versus what is simply clutter or excess. By choosing quality over quantity, you free up not only financial resources but also time, space, and energy, all of which can be channeled toward more fruitful endeavors that contribute to wealth building. It's also valuable to consider the opportunity cost of your expenditures. Each dollar spent on discretionary items is a dollar that cannot be invested elsewhere. By reinvesting what you might have spent on non-essentials into your savings or investment portfolio, the potential for compound growth becomes significantly elevated. Furthermore, as you adjust your spending priorities, it's essential to maintain a balance that ensures your current quality of life remains enjoyable. Drastic and unsatisfactory changes can be unsustainable. The key is to find a sustainable middle ground where you live well today while still planning for a prosperous future. In conclusion, revolutionizing your spending habits is a powerful strategy for long-term wealth accumulation. Breaking free from the consumption-driven mindset and focusing on intentional, value-aligned spending can dramatically increase your financial stability and growth potential. By adopting habits like establishing an emergency fund, avoiding impulsive purchases, and understanding the opportunity cost of spending, you place yourself on a path toward a more secure financial future. Thank you for listening to the end of the video. If you enjoyed it, then please give it a thumbs up and subscribe for more wealth-building advice.